All right, let's pull back the curtain on something we've been looking at. ON Semiconductor Corporation, ticker symbol ON.
ON Semi, yep.
Our mission, as always, is to cut through the noise of these detailed reports, zoom past the headlines and get straight to what you truly need to know.
Gets to the core of it.
Exactly. We're talking crucial facts, financial figures, strategic insights, basically helping you grasp the full picture, not just skim the surface.
And from my perspective, what's truly compelling here isn't just dissecting a company, it's understanding how a really critical player in semiconductors navigates this, well, constantly shifting market.
Right.
We're going to look closely at the data we have, figure out what makes ON Semiconductor tick, what gives it an edge, and, importantly, what challenges it's wrestling with right now.
Absolutely. So let's kick things off with that immediate financial snapshot, the quick pulse check.
Where do they stand today?
Right. So as of August 5th, 2025, the stock was trading at $47.24 USD. Did see a slight dip that day, about 1.52%. But you zoom out a bit, and, well, we're talking about a pretty substantial player here. Market cap around $19.74 billion. And the enterprise value, looking at the trailing 12 months, that's TTM, is $20.59 billion. So clearly not a small fish.
No, definitely established.
But for you as an observer, the critical question right away is, how does this current price stack up against what the experts think it's actually worth?
Yeah, the valuation question. Always key.
Always.
So connecting this to the bigger picture, the analysis we've got points to a fair value for ON Semi at $49.55.
Okay, slightly above the current price then.
Slightly. And our internal price target aims a bit higher, looking towards $54.22.
Right. Now,
to give you some context on how the market sees its value relative to earnings and cash flow, their trailing 12-month price to earnings, the PE-TTM, that's sitting at 42.05.
Wow, okay, 42. That sounds a bit high.
It is on the higher side, yeah.
Right.
It suggests investors are paying a premium for past earnings, but the forward PE looking ahead is more like 20.4.
Ah, so expecting earnings to grow significantly then.
That's the implication, yeah. And their price to free cash flow is 13.03, which looks, well, a bit more reasonable. It shows how the market values the cash the company actually generates.
Gotcha.
But, and this is really important, you have to look at the volatility. The 52-week range is huge. $31.04 all the way up to $78.61.
Whoa. That's a massive swing.
Massive. It tells you there's significant market sentiment shifts around this stock. It's definitely not for the faint of heart, let's say.
Or for someone checking their portfolio every 5 minutes.
Exactly.
So we've seen the financial snapshot, the numbers, but numbers only tell part of the story, don't they?
Never the whole story.
For me, the real story starts with what a company actually does. What problem are they solving? What's at the heart of ON Semiconductor?
Absolutely. And what makes ON compelling isn't just what they do, but how they're positioned. They bill themselves as a provider of intelligent sensing and power solutions.
Okay, sounds techie. Break that down.
Right. Essentially, they make the fundamental bits, the components, that let modern electronics sense their surroundings and manage power really efficiently.
Okay.
They split this into 3 main groups: power solutions, advanced solutions, and intelligent sensing.
Got it.
And their strategic focus. It's incredibly clear and, frankly, pretty smart. It's all about the electrification of cars.
EVs, yeah, big trend.
Huge. Making them lighter, go further on a charge, developing super fast charging, all that stuff relies on advanced power components.
Makes sense.
And beyond cars, they're also big in sustainable energy, solar, industrial power, energy storage systems. They're embedding themselves in the infrastructure of the future.
That's fascinating. So they're becoming this, like, almost invisible but totally essential enabler for these massive shifts in tech and energy.
That's a good way to put it.
So what's truly unique about their position then? What's the cutting-edge tech they're using?
Well, what really jumps out from the data is how ON positions itself as the, get this, only broad-based U.S. power semiconductor supplier addressing AI infrastructure power delivery challenges.
Only one. Wow. Okay, AI power. That sounds important.
It's huge. As AI models get bigger, they consume enormous amounts of power. ON is stepping in to make that power delivery efficient, reliable.
How are they doing that?
Through strategic investments in next-generation wide bandgap semiconductors, specifically their EliteSiC technology.
EliteSiC silicon carbide.
Exactly. SiC is a super efficient material, less energy loss, less heat, absolutely critical for EVs and high-performance AI data centers.
Okay.
They also have their Trio platform, which is like a specialized toolkit for complex power management, making it easier to integrate these advanced
But
parts.
any real-world examples?
Definitely. They're providing power components for Xiaomi's YU7 electric SUV lineup. That's a major player.
Okay, Xiaomi. Big name consumer tech moving into cars.
Right. And on the AI side, they're collaborating with NVIDIA.
NVIDIA. Okay, that's obviously huge in AI.
Absolutely. It signals ON's role in defining the next generation of AI infrastructure. They're helping accelerate the shift to 800-volt DC power architectures for data centers.
800 volts. Why is that important?
Higher voltage means more power delivery with less loss and smaller, lighter cables. It's a massive leap for efficiency and performance in those power-hungry data centers, optimizing every electron, basically.
Got it. Powerful stuff. Now, every company needs defenses, right? Competitive advantages. ON Semi has a narrow economic moat rating. What does that mean and how robust is it really?
That's an excellent point. Narrow means they have some advantage, but it's not, impenetrable like a wide moat might be.
Right.
For ON, that moat comes mainly from two things. First, strong intangible assets, their IP, their leadership in specialized power and sensing tech. We talked about Elite Trio, that unique AI power position.
Mm-hmm.
Second, high customer switching costs. Once their chips are designed into, say, an EV powertrain or an AI accelerator,
It's hard to rip them out and put something else in.
exactly, very costly and time-consuming for the customer. They get deeply embedded.
Okay.
And their FabRight initiative helps too. That's their strategy to improve cost efficiency and focus on higher value, higher margin products. Makes their solutions more attractive overall.
So the moat is there, built on tech leadership and customer stickiness, reinforced by efficiency efforts.
That's the idea, making themselves indispensable.
So given these defenses and their strategy, how did this translate into recent financial performance? Q2 2025 specifically. And how did the market react?
Well, the Q2 results revenue came in at $1.47 billion. That was actually down year over year.
Which out? Okay.
Yeah. And their non-GAAP EPS, that's adjusted earnings per share, was $0.53. Now, interestingly, these numbers were generally in line with the guidance they'd given.
So they met expectations.
Pretty much. Yet despite that, the stock price took a hit.
Why, if they met guidance?
It seems linked to what management called near-term customer cautiousness. Basically, even though the numbers were okay, the feeling was that customers were being wary, maybe holding back on orders.
Gotcha. Sentiment-driven.
Seems like it. And a key factor hitting their gross margin, the profit on sales after production costs, was something called non-cash under-absorption charges.
Okay, jargon alert. What's that?
Yeah. It basically means their factories weren't running full tilt, only about 68% utilization.
Oh, okay.
So the fixed costs of those factories get spread over fewer products, which hurts the margin per product. Even if it's not a direct cash outflow right then, it reflects underutilization.
Understood. So what are they guiding for Q3?
For Q3 2025, they're projecting revenue between $1.465 billion and $1.565 billion. Non-GAAP gross margin between 36.5% and 38.5%, and non-GAAP EPS between $0.54 and 64 cents.
So kind of flattish revenue compared to Q2, maybe slightly up on EPS.
Roughly, yeah.
Yeah.
But management's commentary suggested they're seeing signs of market stabilization. That's a positive signal.
Right.
Plus, they're sticking to ambitious long-term targets, aiming for 53% non-GAAP gross margin and 25% free cash flow margin for the full year 2025. That shows discipline and a focus on profitability.
All right, those are pretty strong targets.
Yeah.
Okay, so we have the numbers, the strategy, the recent performance.
Yeah.
But like always, there are different ways to read this, aren't there?
Absolutely. Different interpretations.
So how should we interpret these contrasting views from analysts? The bull case versus the bear case.
This really gets to the heart of it for any potential investor, doesn't it? How do you weigh these competing forces?
Exactly.
Okay, so on one hand, the bullish arguments are quite compelling. Analysts love the clear strategic shift to high-growth, high-margin areas.
EVs, AI data centers, industrial automation, the megatrends.
Precisely. These are expected to fuel significant long-term growth. Their differentiated tech, like Elite and Trio, and that unique AI power position, that gives them a strong competitive edge.
Their moat, basically.
The FabRight initiative is also seen as a success, genuinely boosting efficiency and supporting those ambitious margin targets. And finally, they've got strong design wins with big names, Xiaomi, NVIDIA, Schaeffler, plus those early signs of market stabilization. It paints a picture of a company investing smartly for the future.
Okay, that sounds pretty positive. What's the flip side? The bearish arguments.
Well, the bearish arguments raise some crucial flags. There are real concerns about near-term market headwinds and demand weakness.
That customer cautiousness again.
Exactly. It led to revenue declines in some areas like automotive in Q2, and that gross margin pressure from underutilization running factories at 68%. That's a drag.
Right, the underabsorption charges.
Yep. And their silicon carbide margins are apparently still below the company average, so that needs to improve. Then there's a projected revenue headwind in 2026.
Or headwind from what?
It's estimated around $300 million, maybe 5% of 2025 revenue. It's because they're strategically exiting some legacy, lower-margin businesses. Good long-term, maybe, but a short-term hit to the top line.
Portfolio rationalization. Okay.
Right. And lastly, inventory levels are up 208 days, including what they call bridge inventory, basically extra parts for transitions. Management expects it to peak, but high inventory is always a yellow flag.
Raises questions about demand or management, yeah.
And their free cash flow dips sequentially in Q2, showing some volatility there too.
So it really is a mixed bag, isn't it? Long-term promise versus short-term hurdles.
Definitely a balancing act.
And it seems even insiders are a bit divided, or at least the activity is mixed. Though worth noting, Q2 2025 data showed more purchases than sales 8 buys versus 2 sells.
Okay. Could be seen as a flicker of internal confidence, perhaps, but not definitive.
Not definitive, no. Okay, let's shift our gaze forward then. What are analysts forecasting for ON Semi?
Well, the consensus for future revenue and EPS actually projects declines for both fiscal 24 and 25.
Declines. Okay, that lines up with the near-term headwind.
It does, but here's the kicker. After that, they expect significant recovery and growth from fiscal 26 through 28.
Ah, the classic U-shaped recovery. Down first, then up strongly.
Looks like it. And the average analyst price target over the last 6 months is around $60.
$60? Okay. That's a decent bit above the current $47 and even above that internal target you mentioned earlier.
It is. Though, of course, individual targets in our source material vary quite a bit. There's a range of opinions out there.
Naturally.
Which really brings us to an important question for you, our listener, to ponder. How do you balance ON Semi's clear strategic direction, aiming right at high-growth markets like AI and EVs, with that near-term market cautiousness and the internal restructuring?
Yeah.
I mean, this is a company actively reshaping itself. It's like they're rebuilding the plane while it's flying.
That's a great analogy.
And that kind of transformation, while it can be really promising long-term, it almost inevitably comes with the near-term trade-offs, volatility. The path isn't always smooth.
Absolutely. Well, we've really unpacked ON Semiconductor today. Moved way beyond just the headlines, I think. We looked at the strategy, the market position, those dual forces of opportunity and challenge.
It's a complex story, definitely, but crucial for understanding the broader tech landscape.
So the final thought for you, our listener.
What stands out to you from this deep dive? As you reflect on ON Semi's journey, maybe think about how companies in these fast-moving sectors like semiconductors have to constantly juggle breakthrough innovation with unpredictable market swings.
Yeah.
That path to long-term growth, it's rarely a straight line, is it? It's more like a dynamic dance between invention and adaptation.
Well said. Okay, if you found this deep dive valuable, and we certainly hope you did.
We hope so.
We really encourage you to subscribe to our channel right now. And hit that bell icon too. That makes sure you don't miss out on future insights.
Yeah, your support really helps us keep doing these detailed explorations.
It absolutely does. It helps us bring you closer to being truly well-informed on these complex topics. Thanks for joining us.